right, on another day in this lovely boot camp that we're running here today. To me, I feel like the recordings, the fact that these are on YouTube, the fact that these are free is just amazing because, especially for people who have kind of been tapped into the education and maybe are not anymore, or people that aren't at all, right? This definitely is going to be just some tools and resources that are going to help. So, thank you guys for tuning in. Like I said, let's go ahead and keep sending this link out, right? If you guys know anybody, like I said, send this link out to people that you guys feel like would take away from these calls. And we're going to go ahead and, like I said, dive into part 2 of our smart money concept. So for those of you that were on yesterday, what we're going to basically be doing today is just piggybacking off of yesterday, as well as going through a couple of the other confirmations that we just didn't cover yesterday. Obviously, in terms of just time, we don't necessarily have all the time in the world to sit here and go in depth for hours. I wish we did, but unfortunately, I have other responsibilities and things to do as well. So just in terms of that, like I said, what we're really going to be focusing on today, right, for most of you guys, right, okay, so basically what we're going to be focusing on today is institutional areas or trap candles. It's really whatever you're calling them nowadays, right? But basically what we're going to be just going over is the importance of how to identify where essentially the banks and where these areas where these hedge funds and, like I said, just large liquidity providers are actually entering the market. So it's just really important to be able to mark up these areas and also understand the importance of why these areas are going to be crucial to identifying just how to position yourself. Because at the end of the day, with everything in trading, as much as it's going to come down to technical analysis, it's really going to come down to your fundamental um, understanding of just how to manage your emotions and psychology while managing these positions. Okay, so basically today, like I said, what we're going to emphasize is just how to identify these areas where we don't have to come back to, but in terms of just continuing to either drive price up or down, what the algorithm is typically going to look for is just certain fills in the market that are going to allow price to continue up with just healthy price action. So unhealthy price action is just areas where there's a lot of insufficiencies, right? Insufficiencies are imbalances. So that's what we really have to sit here and focus on when it comes down to trading as a whole. It's going to come down to the institutional areas. It's going to come down to what we really do to identify what's going on in the markets, right? So what I'm really going to do for the rest of the week, right? I'm not even going to do like YouTube lives anymore for the boot camp, right? I'm just gonna do Zooms for the people that really tap in, because to me, it's like it's just a matter of being able to take advantage of what's going on, right? There's 40 people in the chat, right? There's 7 people on the call. It's like out of the 40 people, it's like all of those people in that chat, right? And even if you're on the call, it's like all you guys are in the chat looking for something to enhance your trading. But the first step is just showing up. So you guys that are on the call are already ahead of most people. Because like I said, when it comes down to what I'm teaching you, like nobody's really teaching you this shit, taking time out of their day to do this for free. I'm doing this at 7 o'clock. I could be making dinner. Right? I could be eating my cantaloupe, drinking my coffee. But, I'm here running these calls. So the most important thing, even for you guys on the call, is not to just sit here and think, oh, just because I'm on the call, you're going to be able to be ahead of the person that's not. It's really being able to be on the call, take as much away from the call as you can, and then apply it so that you're going to be able to get a different result in your trading, so that the people around you, you're going to start to realize that, damn, like, these people are not taking advantage of the same information I am, because I'm actually progressing in my trading, and you're going to start to see that the people around you are going to stay stagnant. So you guys already just got to give yourself a pat on the back for showing up, because like I said, it's just accountability and discipline, right? So when it comes down to our institutional areas, I'm going to show you guys kind of how to identify just which areas are going to be the most relevant, because a lot of people kind of get confused with this. I feel like this is probably one of the most confusing parts of just like smart money concepts. So really, for example, right, if we were to sit here and kind of just draw out some price action. Okay. So when we sit here and just take a look at this, right? So what we really want to do in terms of being able to identify, okay, which areas are going to be more valid? The first thing that we have to do is just go to the 4-hour, the daily. Like we have to start off on a higher time frame bias, because one of the biggest mistakes as new traders is, especially new traders, is sometimes we just get excited, so we dig down into the smaller time frames. We're on the 15-minute, the 5-minute, the 1-minute. It's because when we're new, what ends up happening, I think this is really going to be relatable for a lot of people, but we'll sit here and we'll be looking at an area on a 15-minute, 30-minute, and then we'll feel inside, we're like, this doesn't feel so well. Like, this doesn't feel like it's going to work out. So then we'll try and break it down to the 5-minute, 3-minute, 1-minute to then make ourselves feel better. So we're sitting there just trying to, okay, the 5-minute looks like it could keep going actually, so I'm gonna keep playing it, right? Then the 5-minute area gets stop loss hit. Then you go to the 3-minute area. You're like, okay, has to be this one. This one looks clean, right? You get a little 10-pip bounce. You go a couple pips in profit. Then stop loss hit. Then you're like, all right, the 1-minute has to work, and then that's just the redundant cycle that we stay in. Okay, so when first identifying valid institutional areas or trap candles, what we first have to do is identify the range that we're trading in, right? So if we sit here and we just take a look at this, up until this big drive up, we were relatively in the same area, right? We were consolidating. We weren't really going too much higher than this area. Obviously, this was the high that we made. But in terms of just price action, we created a lot of consolidation, okay? So when it comes down to institutional areas and trap candles, what we're typically looking for, right, is mitigation. Okay, so mitigation. Does anybody know the definition of that? Right? Can you guys drop in the chat what mitigation means? Curious to see if anyone knows. Because what mitigation essentially means in the context of this trading is simply right? So mitigation simply means to lessen or remove. So for example, when we're talking about trading and mitigation, what we're talking about is simply the areas where that manipulation comes in, right? Where we get that impulsive buy candle before the sell move, or that impulsive sell candle before the buy move. What price has to do in order to drive up. So for example, right? The banks, when they get into the market, right? What they are doing essentially, right, is they are buying the market up, right? So they'll sit here, for example, and they'll buy the market up on 100 lots, right? This is a very, very, like, this is just trying to put it into perspective for you. They're using way bigger lots than 100 lot. If you think 100 lot is a big lot, that they're using 100 million lots, right? The banks. So imagine they're buying the market up with 100 lots. What they're then gonna do, right, is drive price down, right? The reason why they're gonna drive price down is because, why? Well, when we look here, what is this? Well, we have some liquidity, right? What is liquidity really something that we use in terms of the market? We use it as a target, right? We use it as an area to take profit, right? Even in here, we have liquidity. Okay? So we have equal highs, equal lows. We have liquidity within this area, right? So you have to notice how as the market's driving up, what the banks will do is they'll drive price down, right? So they'll sell the market down. So if they bought it up on a 100 lot here, they're selling it on a 200 lot here. So they're selling to drive price down even lower than it previously was. Then what they'll do is they'll buy it back up again. So what ends up happening is these areas where you see these big impulsive down candles before the up move, or where you see that big up move before the down candle, right? These areas are going to be known as your institutional areas or trap candles. And the reason for that is because in terms of the institutions getting in, like I said, this is just the area where they start to manipulate price, right? They sell it to then buy it. But the reason why, it's called a trap candle is because it's basically trapping sellers, right? Because people are selling, price gets down here and then automatically bounces back up here. So sellers are getting trapped in here. So what we have to do, right, is return to these areas. Because think about it. If the banks sell the market here, but then they drive it back up, what happens to the sells? The sells go in drawdown. But the thing about the banks is they're not like us, family. They don't hit stop loss. They don't sit there and they don't margin hit and trade gets... No, none of that happens, family. They're trading with hundreds of billions of dollars, okay? So when they sell the market, they could be in $10 million drawdown, but they're going to be up $50 million, $60, $100 million, $200 million in profit on the buys that they have. So what they're going to do is they're going to take profit on some of the buys, and then they're going to sell the market back down. So notice how price, in terms of a structure aspect, we create a new high, right? Our previous lower high, or our previous, in terms of just validating this bullish structure, right? We had this higher high. We created a higher low, new higher high, higher low. And this is what you have to understand about structure. Structure, when we come back and we make those higher highs, higher lows, that's us coming back to these institutional areas or trap candles to what? Mitigate, right? And what is mitigate? To lessen or to remove. So if the banks sold the market down here, when they sell it back after we make this new high, they're selling it to simply close the sells that they previously had here. Drop it 888 if that makes sense, family. So they will literally sell the market here to then buy it up, to then sell it back down to close in drawdown, or close in profit, close with a small loss, whatever the case may be, right? And then what do they end up doing? They buy it back up, right? So this is why sometimes you see, right, we have this down candle before that new up move, and then you see price comes back. Like, notice how we make a new high, come back to this same area, right? We make a new high. What do? Come back to this same area before then continuing higher. Okay? So how you're able to sit here and play your positions, for me personally, when I'm playing institutional areas, if I'm playing a candle, I'm going to sit here and I'm going to play this last drive down, but pay attention to this, right? This is going to be one of the biggest pieces of sauce. It's not just the last down candle. It's not just the last couple of candles, okay? It is the last candle that not only swept lows and captured liquidity. Liquidity being captured is one of the most important things you want to see in an institutional area and a trap candle. So we have this consolidation. We drive down, we capture liquidity. That is literally probably going to be one of the biggest reasons why you now start to get at least like a quick little bounce in your trades. And it's going to be because of the liquidity capture. You have to stop being scared when we take equal lows that we're going to continue to go lower, especially if you have a POI in that area. If you have a point of interest, why are you scared that we consolidated above your area, swept equal lows, and then drove higher? Like, this is something where I'm telling you, we really have to use the confluence of all of these little things, okay? So we have the liquidity capture, then the drive up, okay? So we come back one time, two time, three time. Mitigation, we are not just going to mitigate one time. I want you to write this down, okay? We can mitigate 5, 6, 7, 8, 9, 10 times. I can show you guys times on gold on like the daily where we come back and we mitigate out of the same candle like 10 times over the course of like 3 months, 4 months, okay? So when we sit here and we're identifying the areas, like I said, when you're looking at this last drive down that captured liquidity, but it also validated that structure. So after we took liquidity, we made a higher high, right? That's the third confluence that you get after the liquidity sweep, right? After it being in a POI, what you want to see is the structure validate in terms of confirming that higher high or that lower low, okay? So now that we understand just the whole concept, right, of institutional areas, trap candles, how to sit here and how to identify where the institutions are getting into the market. Now, the next step is really being able to apply this to the actual charts. Because like I said, this is typically what you want to see. But for the most part, like I said, there's going to be a bunch of different areas. And I know it could get confusing at times. But if you're genuinely focusing on areas, like I said, that are capturing liquidity, right, on that impulsive drive down, what's fast doesn't last. So you notice how we're slowly walking price up here, and then boom, quick impulsive push down. Then we drive higher, okay? So even though we drove high and we were impulsive, the reason why this is not necessarily insufficient is because of that downward movement, okay? So what we have to sit here and now do in terms of applying this to the market is sit here and be able to look at just the same type of ranges, look at the same type of areas, and really dissect, okay, how are we going to be able to really sit here and find the right candles? Like, Cash, how do I know which one is the right institutional area? Okay, well, the first thing that you're going to want to do before you even identify which institutional areas that you're going to want to play, because what ends up happening is we get to the higher time frames, right? And it's like price is currently right here. Okay. So it's like people might identify the range, and to me, the current range that we're really trading in between, this would be the most relevant range in my opinion, right? To me, when I say relevant range, I mean relevant to current price action. And the reason why this is all relevant to current price action is just due to the simple fact that in retrospect to where we are in the range, we're close to the bottom. We're probably close to the 78.6, right, of this whole range, okay? So when you see this, like, I'm not guessing. Like, you guys see in terms of the number? Like, this is literally exact. We're at the 78.6, almost on the dot. That is exactly the number, 78.6. I'm telling you, when you sit here and you start to trade long enough, you don't necessarily need to just have all of these like lines and fibs and all of this stuff on your chart. Like, I can sit here and identify the range that I want to be taking a trade in just by eyeballing it. Okay? So when we sit here and now dissect, okay, this range, right? I'll put the fib back up just for people that just don't really see this as clearly. In terms of identifying a range, oh shit. What you want to do when identifying the range and finding your institutional areas, you need to sit here and figure out where is your discounted price area. A lot of people will tell you, boom, 50%. No, the 50% is trash. If you're getting in on genuinely anything below or anything on top of this 0.786, you're probably getting in the middle of the range, and you're probably going to have trash R&R. I'm just being honest, right? 1 to 2, 1 to 3 R&R is not good. If you think that's good, try sitting there and going on a 10 losing streak with a 1 to 3, right? And then try and get out of that hole, okay? When you're trading with 1 to 10s, it allows you to sit there and be wrong a couple more times, right? You can lose 7 out of 8 trades and you can still be profitable if you're trading 1 to 10s, right? If you're trading 1 to 3s, it's like you got to win 30% of your trades to be profitable, okay? So when you sit here and you dissect the range, to me, I like my sweet spot is not just this 0.786 to the 100%. I actually look all the way down to the 110%. So write this down. The 110% of the range is going to be a liquidity sweep. That's going to be a stop run. That's what you call a stop run. Because when you think about it, like I said, this is the bottom of the most relevant range that we've been trading in. Like I said, the reason why it's relevant is because we're right above this area, right? And in terms of how gold moves, to get to the bottom of the range, we're about 170 pips away. 170 pips, that's sneeze. You see what I'm saying? Gold sneezes, that shit's moving that much, okay? So when we sit here and we're identifying, okay, which areas are going to be our institutional areas? Well, like I said, if we just sit here and now just even look at the top of the range and the bottom of the range, you're going to be able to kind of see in itself just what is happening, okay? So when we sit here and take a look at where the reversal initially happened, okay, this is where your institutional areas are going to be, typically where reversals are occurring, okay? So when we sit here and we look at price, I'll make this clear, okay? When we just look at price within the range, overall as a whole, like I said, we're maintaining very bearish structure, right? We're creating lower lows, lower highs all the way through here up until really this point is where we get that break of structure. Okay, so where the break of structure would occur, just in terms of paying attention to where lower lows and lower highs were being created, right? In my eyes, once we close above this, right, that would have been a valid break of structure. Okay, so notice, okay, this is the start of that last drive up before we drove price down. Okay, so the market sold off to then break structure towards the upside and then continue higher. But now when we sit here and dissect, okay, the start of this last drive down really was in here. Okay, so from this candle all the way down basically to this last red candle, okay, that would be our institutional area. And this is what you have to understand. It's not just one candle. It's not just this last down candle. This is where a lot of people get tricked out of their cards. And this is how you guys miss a lot of trades, because you only play this last down candle, right? But what we have to sit here and be able to do is identify what is going on beforehand. Okay, so now if we sit here and we go to the hourly, okay, the hourly break of structure actually occurs once we break above here. Okay, so now that we can sit here and we can identify an hourly break of structure, the first thing that I can really sit here and see is, okay, this candle right here, your institutional areas, write this down, your institutional areas are going to be typically areas of manipulation. So this red candle, this one down red candle, the reason why this is going to be our main point of emphasis, just looking at the hourly, is just for the simple fact of look at every fucking other candle around this shit. like, excuse my language, but I'm telling you, this candle is huge. Like, this shit is like literally like quadruple the size of everything around it, besides these two big buy candles that we got immediately after. And the reason why I'm going to explain why these two candles after are not really like that's normal is just because of the institutional area. So when we sit here and we just look at, okay, this very large down candle, this candle is clearly more manipulated than all of these other candles. Why? Because look at how large it is. Look at how big the body of the candle is. It's not just like a quick wick and then dip. That means with the big body, price offered a lot of sell orders within that 1 hour candle. Okay, so if we sit here and now we're just immediately looking at, okay, this right here, if you guys were on yesterday's lesson, literally where we came back and filled, I sit here and just get rid of this, right? We came into an imbalance. This right here was an imbalance that we had on the hourly. If we break it down now to 30-minute, 30-minute, really the same thing. Like, notice, remember I told you with the little wicks, so realistically the imbalance would have been in here, right? Notice how we come and we virtually fill all of it, right? When we're looking at the 30-minute and we're looking for insufficiencies, There's a little imbalance below here, yes, but this is where I said again, some people kind of get tricked out of your marbles. Because if we're really in accumulation and we're really in phase C, phase D, we're not going to run really too close to whatever low that we made. So this is why we have to kind of pay attention to these fills. Because like I said, the most important part of everything is, okay, look. Structure-wise, okay, look. We created a new high once we obviously got these 3-4 consecutive buy candles. But if we look to the left, what did we do right beforehand? We had a lot of liquidity right here. We had money resting. We had people that were buying early, right? People bought early into the market here to then get hit out here. This is the story of everybody's life, right? Buying a little bit too early, price driving down, them being too scared to re-enter at the low point, them getting back in at the top, getting hit out the last time, and then price going in your direction and you not being in the trade. This is literally like the most perfect sequence of how 90% of traders miss moves because of just a lack of understanding. Okay, so not only do we capture liquidity, right, by driving down here, we break structure to the upside, and look at how fractal this is, because what do we do immediately again during this Tokyo session, right? We're creating liquidity. We are literally creating equal highs and equal lows. We dead ass move sideways for all of Tokyo session. And notice how right at the beginning of London session, we break down. So what are we doing? We are capturing liquidity. In terms of our institutional area, we are mitigating, right? We are lessening and removing just the sells that were offered in here that was clearly manipulation. Okay? How we break it down to the 50? Like I said, you see how we start at the highest time frame basically, and we're finding confluence on virtually every single time frame down the way, right? So now when we sit here and we really look at the 15 minute, to me, the fill is virtually the same. But let's see. Oh, I can't even see 5 minutes. So even with just the 15 minute as a whole, like I don't know, I'm pretty sure the 30 minute was probably the cleanest. Because to me, 15 minute wise, I like to play the 100% of the imbalance fill. So I personally, like I might have still taken this, but it's like I would have still been a little bit on the edge looking at the 15 minute. But the 30 minute, like I said, just based off of the break of structure here, the fact that we filled this, it would have been a lot easier right there. Okay. So now when we sit here and we go to the top, right? Now what do we see on the flip? Well, the same thing, okay? Obviously, we're bullish, bullish, bullish. We're maintaining that bullish structure, right? Then what ends up happening? Well, shit. In terms of a 4 hour perspective, to me, once we close below here, in terms of the 4 hour, right? This is where a break of structure would have happened. But notice, right? We get this big drive up starting here. Okay? The start of that final push up is literally right here. Right? So the beginning of the last push up. So this is where the buys start before we then sell off. So do you notice how when we sell off, we literally buy back up into this area? Why are we buying back up to this area? Because we need to mitigate. We need to lessen and remove the buy orders, right? To remove the drawdown that the institutions, that the banks are in order to then continue to push price lower, which is the intended target. Okay? So this is, like I said, just something that is so crucial when it comes to understanding, because once we even come back in this area, right? This now is our new institutional area. This is our new relevant one. The reason why this is relevant is because this top one we already came back to. We already revisited it, right? We haven't really revisited this one yet. So what ends up happening? Once we make a new low, we come back up on the 4 hour, right? These last 4 candles, right? Or these last 3 up candles, that's the start of that last drive up, right? You notice how that's literally where we come back into, right? We have a little imbalance right below that too, right below that area. Right, we had imbalance in here, which we virtually filled all of it. So taking a look at this, like I said, it's just fractal in terms of being patient, because it's like, for example, the fact that we dumped all the way down here and we didn't return back, at least to me, actually we did, right? So even in this particular case, right, we come all the way back up here, we drop. A lot of people would have been like, okay, cool, I'm looking for price to come back into this candle, right, this large up candle. But the thing about the mitigation, like I said, is it's not just that last up candle, it's this series of last up candles. So these last two candles here is the start of that institutional area, the start of that trap candle, right? So if we sit here and we even look at the body of this candle, right, we just barely missed the body. But if you sit here and look at where all of these wicks are coming back to, this is an example of mitigation in itself right here too, right? It also is an imbalance fill because we have an imbalance in here. But this is what I say, adding up the confluence, right? So this wick and this body, right, is the start of that last drive up. So that's our trap candle. It's no coincidence that there's an imbalance literally in the same spot where we need to come back and mitigate. This is why I say the market is so fractal when it comes down to being able to sit here and reposition yourself into the markets just on a consistent basis, right? A lot of people sit here and it's like, they think this is easy, right? If it was easy, it's like, there's a reason why when you guys hop on the calls on the live trading, we're able to identify these institutional areas very easily. It's like, people sit here and they think they can understand because they hop on one call and they watch it one time. It's like, no, you have to sit here and you have to apply these things over and over again. You have to watch it over and over again. It's like, you know, for example, lots of people are just dipping out right now because they might feel like, oh, this is easy. I know this. It's like, why the fuck are you, like, why are you still working a job if it's easy? If it's easy, why are you working a job you don't like if you have to, right? Why do you sit here and why are you still not just free? Like, to me, it's like, I don't work a job. I don't have a boss. I don't have to go report to someone. I can do what I want. I'm an entrepreneur. Right? I do this because I get to do it, not because I have to do it. Nobody tells me, Cash, come run this call. So this is the thing about being able to put into repetition. It's like, whatever you think is easy, like, this is a quote that I want you guys to write down. This will really, like, help you guys with just being good students, right? And the quote is, if you know something, it shows up in your life. Okay? So I want you guys to really think about that. If you know how to trade, it's going to show up in your life. If you know market structure, you're going to be able to identify the market structure perfect every single time. If you know, like, if I say I know how to speak Japanese, you're going to sit here and you're going to assume that I'm fluent in Japanese. You're not going to sit here and expect the only thing I know how to say is hello. So this is what you have to sit here and say. People say, I know this. I know I have to be patient. If you know you have to be patient, you'd be patient. What are you talking about? You know you have to be patient. That's like the most ignorant statement I hear on the daily. I know I should be doing it. I know. If you know, you would be doing it. So stop being ignorant. Right? Drop a one-on-one if that makes sense to you, fam. If you know it, it appears in your life. Because that, to me, is probably going to be like the biggest gem. One of the biggest gems out of this entire call. Right? Because, like I said, everything comes down to being able to identify just these higher time frame points of interest. Like, for example, dollar. Dollar is probably one of the best examples that I can think of in just recent times in terms of just really what I was looking for in terms of mitigation, imbalance, just all of that, okay? So when we sit here and we take a look at this, right? Really, for me, when it came down to DXY, right, I had this point of interest marked up for a couple months, right? And essentially the area that I was looking to target was a daily imbalance, really in here, right? But what we had was a weekly point of interest. So to me, our weekly point of interest was all in this. So this whole area to me was what I was looking to target, okay? So overall, right, DXY was dropping heavily, right? It was dropping. But it's like, this is an area, like I said, that was marked up weeks before it even came down with the anticipation that it was going to react out of this area, right? How did I know that it was going to react? Well, I didn't. But the reason why I anticipated it could was because overall on the weekly, on the daily, in terms of The last area in my eyes that I just felt like we didn't really revisit, like I felt like almost everything in here was healthy, right? With just how we were coming back and we were mitigating. I felt like this was kind of the only area where we didn't come back to. And I also was looking a little bit lower, right? We had like a little gap in here. So to me, that was why I was ideally looking for DXY to come into here, right? And even with the reaction that we're getting out of here right now, it's like in the next day, basically, we're going to see whether or not DXY is going to melt or if it's going to just continue to fly. Because like I said, I really don't know what it's going to do. On the weekly right now, tomorrow is going to be a very important close for me to be able to just get the overall direction for the next couple of weeks. Like I said, this is a weekly close that I'm paying attention to. It's not a daily 4 hour, 1 hour, 30 minute, like 15 minute. Like this is weekly. I've literally anticipated gold to go down for the last 2-3 weeks, 4 weeks, 5 weeks, and we anticipated it to be flying the way that it has, right? So gold shorts, that's why, even for example, gold shorts, it's like I'm still holding from, I think 1964 is like my best entry, okay? So it's just having that fundamental understanding of, okay, we want DXY to go up for a couple weeks, okay, shit, we could hold gold sells for a couple weeks, and that's what we've been doing, okay? So the goal of trading is to trade less, right? Less is more. If you could sit here and you could take 2 or 3 trades a week, but you can make sure that you're trading 1 to 10s, all you need is 1 trade a week, right? You could lose 2 out of 3. If you're taking 1 to 10s, 1 to 20 risk to reward, if you lose 2 out of 3, you're losing 2% to make 20. You're losing 2% to make 40. Like, let that sink in. A lot of people be sitting here and like, you guys be assholes. You be trying to risk 5% for like 2%. Like sometimes you be risking $30. And you be thinking like, yeah, I'm trading a 1 to 5, 1 to 10, but then you'll close your trade out $20 in profit, $15 in profit, then it'll fly. Then the ones that you don't close, it'll hit stop loss, and it's like your risk to reward. Even though you think you're entering with a higher risk to reward, your risk to reward is actually determined by where you open and close your wins and your losses. You can't say that you trade 1 to 3s when your average win is the same as your average loss. Right? If you're not a profitable trader, you can't say I trade 1 to 3s. If you tell me you trade 1 to 3s and 1 to 5s, to me, I think that you're 3 to 5 times more profitable than whatever you're risking every single time you trade. That's what I think. Because you can't sit there and say, I trade 3%, 5%. You can't say that. So this is why we have to sit here and build up confidence by not only technicals, but by being able to develop the psychological understanding of when not to trade. Sometimes the best trade is no trade. That is probably the best quote I ever heard in trading. Sometimes the best trade is no trade. I never lost money from not trading. I don't know about you guys, right? I've never blown an account from not taking a trade. I've never sat there and over leveraged from not taking a trade. So this is something that we really have to take into consideration. But in terms of that, family, this is really going to wrap up today's call in terms of institutional areas. Like I said, everything is going to be very just kind of basic, watered down. I definitely feel like I gave a lot of sauce today. So make sure that you guys watch the recording. I'm going to upload this as well as an upload onto the main channel. But we're going to be live today. So if you guys missed today's New York session for trading, we'll go live today during London and truthfully probably New York. So I'll be live at probably like 3-4 a.m. in the morning. I'll confirm within the next hour or so, just ideally when I'll be free, or when I'm going to be live. But if you guys are early birds, if you guys are in Europe, Australia, make sure that you guys are just locked in with the group chats to make sure that you guys get the updates. But we're going to be live today for sure during London session, family. So if you guys want to pop out, definitely show up. We'll look over some GER 30. If you guys don't know what GER 30, it's a German index. That bitch be moving at 430, right, or 330. So if you guys know how US 30 moves, GER 30 moves like that when you guys are asleep, right? So if you guys are going to tap in, like I said, make sure you guys have post notifications on so that when I go live, you guys are notified. But I love and appreciate you guys, family. Make sure you guys are locked in. I'm going to catch you guys during London. Peace.